Welcome to this video, a recap of market activity ending June 30th, 2025. We'll look at the key levels that moved the tape and set the scene for the third quarter. This video covers the market's strong close, highlighting key technical levels on the S&P and NDX, as well as the intraday drivers that shaped the session. Reflecting on the quarter, while June was generally flat, the final market activity signaled significant movement, including the JOLTS print and a notable markup into the quarter end. In this video, we will examine 7 key factors that mattered, from macro drivers and technical levels to the performance of semiconductor stocks and our strategic outlook. Despite concerns about light volume, the market's structural behavior remains the focus. This video explains why current market conditions outweigh simple volume metrics. We turn now to the macro section, where a single 10 a.m. data print established the session low, influencing the subsequent movement of the dollar. The JOLTS report was a definitive driver. We observe how this data release established a floor for the session and impacted equity performance on both the S&P and the NDX. Examining the labor data, we see a pattern of resilient job openings. This video provides the context on why this recent strength is interpreted as a bullish signal. The current setup favors a weaker dollar. This transmission mechanism, where lower currency values can support global trade and equity markets, is explored in this section. Looking ahead, we are monitoring non-farm payrolls on Thursday. This video outlines potential risks and what we are watching to gauge the ongoing market trend. Moving to our next section, we analyze the impact of rebalancing, specifically how Russell and pension fund activity influenced the market's recent low point. The rebalancing narrative was central to the week's price action. We trace the events from the early week gap fill to the Friday low and subsequent recovery. On this final day of the quarter, window dressing played a key role. This video illustrates how institutional buying into the close impacts market optics. Why was there a mandate to buy semiconductors? We explain the pressure on funds to hold winning names and how that shaped the market's appearance. Finally, in our technicals section, we note the island reversal on the S&P and the importance of holding these key levels as we move into the next session. The S&P 500 and the NDX closed in a very similar fashion. We saw both indices close right into the levels we were watching, with identical reclaim patterns. When both indices act in unison like this, it increases our confidence in the read. Looking at the S&P 500 pattern, we identified an island formation. After 5 days, the index moved into that area, and by the 6th day, it closed above the island's close, which is a strong signal for reclaiming the high ground. For the S&P, we've seen the first close above both the 12 and 22-day moving averages since the island formed, marking the best close of the entire run. Our focus now is on holding the 740 level to keep the momentum for swing trades active. The QQQ didn't tag the island within 5 days like the S&P, but it successfully closed back above its 12 and 22-day moving averages. With support at 723 and resistance at 738, we remain comfortable looking for swing trade opportunities. Our checklist for resuming swing trades is looking solid. The island has been reclaimed. We are above the key moving averages, and support levels for both the SPY and QQQ appear intact. We are looking for tomorrow's close to confirm this setup. Turning our attention to the semiconductor sector, we see these AI-related names attempting to lead the market once again, and the potential for a significant move is building. The recent breakouts across the semi-cap equipment complex are quite clean, making it difficult to dismiss them as mere quarter-end window dressing. Names like AMD, KLAC, ASML, and LRCX are all showing meaningful strength. ASML serves as a primary example of this shift. Once overlooked, it has now become a major sector leader with a $2,000 price point. The fact that the entire capital equipment complex is following suit underscores that this trend is expanding. We are also tracking the ratio of AI-heavy semiconductors to equal-weight counterparts. We are seeing a structural trend change, with higher lows forming, which suggests that the specialized AI names are poised to lead the next phase of market performance. Looking ahead, there are 3 things to watch: whether DRAM and memory stocks can maintain their current levels, how Asian markets react to their own strength, and confirmation that memory demand holds as we move into the third quarter. It is essential to distinguish between actual market rotations and false narratives. Not every sector move is sustainable, and knowing which opportunities are genuine is key to navigating the current landscape. Recent suggestions to rotate into certain areas like software or the broader Mag 7 Feet group haven't panned out as expected. Names that looked like breakout candidates like Netflix failed to hold their gains, while other sectors like biotech remain under watch. While the Magnificent Seven names aren't necessarily crashing, they have struggled to maintain leadership. After observing failures in names like Meta and Amazon, it's clear that picking the right individual stocks is more critical right now than betting on a whole sector. Finally, we are seeing real strength in industrials, which are hitting all-time highs. This is largely driven by a weakening dollar, which benefits companies like Caterpillar and GE Vernova. These are clear examples of where the money is actually flowing. Gold and silver are showing resilience, which provides a useful contrast to dollar-sensitive sectors. As we head into Q3, we will continue to monitor the dollar's direction, as its performance remains a primary gauge for these precious metal trends. Moving into our trade file section, we focus on the Intel setup. This breakout was a key move, and we'll break it down step by step, along with other notable stocks like Bloom Energy and Credo, and a look at the ongoing weakness in Nike. For the Intel setup, we look at the 930 control bar. Off the market open, this bar printed at 3 times the average true range. A bar of this size right out of the gate defines who is in control of the tape. Following that initial move, we watch for a 3-bar pattern. This occurs when the second bar pulls back to roughly 50% of the control bar's range. Once the third bar establishes a higher high, that's the signal to initiate the trade. In terms of execution, this position was managed as a core swing while also trading the daily price action. Once 10 a.m. confirmed the trend, the strategy shifted to holding the position while trailing our stops. Our exit strategy relies on our private cloud indicator, which tracks rate of change velocity and VIX volatility. When the indicator flips color, it provides a clear signal that the day's trend has likely reached exhaustion. Beyond Intel, we've seen notable moves in Bloom Energy and Credo. Bloom benefited from a Russell rebalance overshoot, while Credo demonstrated a classic quote-unquote rip and dip pattern, highlighting the importance of watching for these specific market footprints. In contrast, the situation with Nike is challenging. Despite beating lowered expectations, the underlying issues in inventory and sales are significant. We are monitoring the $40 level closely as potential future resistance. We now transition to our tactical plan for the upcoming sessions, where we detail the critical levels to hold, catalysts we are tracking, and the discipline required to maintain these positions. To understand our playbook, it's important to define our terms. An island is a gap-isolated cluster, a control bar identifies who owns the tape, and our private cloud serves as our primary trend tool for knowing when the day is done. Looking ahead, our catalyst slate includes upcoming Fed speeches, continued movement in memory stocks, and the all-important non-farm payrolls data this Thursday, which will likely dictate the dollar's direction. Our key lines in the sand remain. For the SPY, we need to hold 740 to confirm the island reclaim, and for the QQQ, 723 serves as support, while 738 remains the level to clear for sustained upside. To stay disciplined, we watch for specific triggers that would force us back to defense, such as failing these support levels, a breakdown in memory sector pricing, or a hotter-than-expected wage print in the payroll report. Summarizing our state of the tape, the current outlook is bullish with the island reclaim on the S&P, but we remain watchful of potential risks like thin breadth in the Magnificent Seven and apparel sector weakness. Thank you for watching. Our community reopens for new members on July 7th and 8th. If you're interested, please check the links in the description for more details on our daily, unedited market analysis.